Yeah, we can start.
Yeah, we've got Bharti also online. So I
Hi,
guess
Bharti.
it's online. So just thank you, everyone. I won't take much time. We're already past 3. So over to you, Arpit, for just quickly giving an introduction to everyone and topic. And, thanks from IVCA and all of the delegates and IVCA members to all of you. Over to you, Arpit.
Okay, thank you. Hi, everyone. This is Arpit, and I have a bunch of very esteemed panelists with me. Today, we are doing this webinar to talk about COVID situation. What else? This is the most unprecedented time that all of us have been part of. I was speaking to my Nanaji, who's about 79, 80 years of age, and he says never in his life he's seen such times of lockdown. So definitely all of us are younger, and we haven't. No one expected. So many people projected their lives and businesses for 2020, and no one expected 2020 to turn out to be like this, which basically tells you how fragile our lives and our ecosystems are, and there are so many things which can go wrong. Black swan events can hit you, and then you won't know what has really hit you until you live through this. Of course, very exciting. I won't say exciting so much, but very interesting times because this will reconfigure a lot of industries in unimaginable ways. It will also force us to think completely from first principles. People who thought they thought from first principles will actually be forced to rethink because they also made certain assumptions, and those assumptions don't stand any chance. Uh, Naturally, as an industry, venture capital PE industry in India has definitely seen a significant impact. All of our portfolio companies are impacted by it. Our business is in a large sense is impacted by it because when the assets don't perform, it is an impact. Of course, anyone who was planning to raise money this year is of course significantly impacted because if you can't go, you can't travel, you can't go and pitch and raise money. And every LP or fund of fund, and Bharti is one of those who comes in, who's thinking about asset allocation, is now battered significantly by public market route that has gone through over the last 6 to 8 weeks. Well, it is interesting times, and without further ado, I would love to go on to our panelists and request all of them to do one quick round of introduction, just to understand where they're coming from, what kind of business do they run, and then we'll jump into questions. Let's just start with you, Shashank.
Thanks, Arpit. Hi, my name is Shashank.
Your voice is a little low.
Am I audible now?
Yes, better. Thank you.
Much better. Yeah.
So hi, my name is Shashank Randev. I'm the founder VC at 100x.vc. We are a seed fund which invests in early stage startups using iSafe, which is India's simple agreement for future equity. We launched the fund in July 2019. We are the first institutional investor in our portfolio companies, investing up to 160K USD per startup. The thesis is to invest in 100 companies. We've gone ahead and invested in 20 startups till date. Very sector agnostic with a focus on investing in India domiciled startups. And we're sponsored by Mehta Family Office. That's the largest LP in our fund, which is the family office of Sanjay Mehta. So that's the quick introduction from my side.
Thanks, Shashank. Ashutosh?
Sure. So I am Vice President at Lumis Partners, which is an operating investment fund, focuses on few sectors like supply chain, healthcare, and human capital, which includes education and human resource. I'm also one of the managing partners at Supply Chain Labs, which is an initiative which we launched last year, specifically to develop an ecosystem around supply chain sector in India. So Supply Chain Labs is a fund and an accelerator combined into one, where we not only invest, but we actually interact very closely with all the startups as a part of a cohort that we launch and various activities that we do. That is it from my side.
Thanks, Manu.
Yeah, hi. My name is Manu Sahani. I'm a principal at CX Partners. We are a mid-market private equity fund which is investing out of our second fund. We focus on 4 specific sectors primarily, which is healthcare and pharma, financial services, ITES, uh, and healthcare, pharma. These are the four sectors we primarily focus on. Some of the key investments we've done in the past are investments like Barbecue Nation, Thyrocare, Mrs. Bector's Foods, Ujjivan Financial Services, and the bank, etc. That's a little bit of a summary about us.
Thank you. Bharti?
Sure, thanks, Arpit. So I am a vice president with NewQuest Capital Partners. We are a Hong Kong headquartered secondaries focused private equity fund. We manage around 2.3 billion in AUM, and we are currently investing out of our fourth fund, which is about $1 billion. Our funds are pan-Asia, with India allocation being around 45% odd of the total capital that we have. What's interesting about our business is that we are a secondaries focused firm, which means a couple of things. Our broader objective is to provide liquidity to existing investors in the system. This could mean that we buy out direct GP stakes from these investors, and that constitutes 70% of our business. Or it could mean that we help our GP partners with different sort of fund solutions where we are the sponsor LP. And that's around about a third of our business. Overall, we are sector agnostic. We don't do very asset heavy sectors, but besides that, we really look at everything that's out there. Our stakes in our companies range from full buyouts to minority positions, and a single asset we can write, up to even $100 million. So that's a little bit about us.
Thank you, Bharti. For everyone who's listening and just tuned in, my name is Arpit. I work with Bloom Ventures. We are an early stage venture capital firm, sector agnostic but stage focused. We have offices in Delhi, Mumbai, and Bangalore. We are currently operating from our third fund, and I've invested in some of the winners like Unacademy, Grey Orange, Dunzo, Spinny, Milk Basket, and so on. Okay. So great. Thank you for everyone for their introductions. It's good to have all of you. Welcome. I'm basically dividing our rest of the time. We have about 50 minutes on this call into 4 parts. We will talk in the first part about what is the impact on our portfolio, and I would love to have some key insights as to how you have assessed the impact on your portfolio companies, and what are the best strategies that you want the audience to take back from the learnings from the portfolio perspective. Ashutosh, you want to start with some learning from your portfolio? Also, I know that you do slightly earlier stage now with Supply Chain Labs. Please talk about that as well.
Sure. So, thank you for giving me this chance to talk about some of the initiatives that we are driving, right? So I have been involved with 5 companies directly, which I am directly managing. And this thing has, although the roots are Chinese, there was some visibility into how this thing was quickly becoming a global kind of a pandemic as early as January, right? So we started having conversations, very, very initial conversations in the late January itself, right, where some of the Chinese counterparts that which we were talking to had started saying that this is not something which will remain in China; it will go out, and from there on, we. But that conversation was very, very initial, and as much as I would like to say that we were prepared, we were not, right, and neither were the portfolio companies. So it hit us like a brick in the first week or second week of March, and from there on it quickly went down very, very fast, right? So in the second week of March itself, we started having very serious conversations with most of the portfolio companies on saying that, guys, we'll have to figure out a strategy. Now, we divided that strategy into various aspects. One is obviously cost preservation, which Arpit was talking about, right? So cost preservation, the normal routes of how do we figure out the total burn and reduce it, all the expansionary activities, marketing spends, we said that we'll have to have a very close watch on that and figure out where is the ROI coming from, if at all, by the way, right? And even on the other direct and indirect costs, very serious conversation. The second thing that we did with all the portfolio companies was scenario analysis, right? And irrespective of the stage, I have a company which is seed stage, and there is a company which is nearing Series B and looking to raise that. Irrespective of whichever stage that these portfolio companies were, there were very comprehensive scenario analysis done, right? So that scenario analysis essentially started from the top, saying that, okay, these are the revenue projections that we have for this year, FY 2021, right? Based on what are the best case and worst case scenarios, and those revenue projections then are trickling down to the cost projections. They are also trickling down to all the other activities, right? So how would the fundraising plan look like? How would the hiring plan look like? How would the technology development plan look like? What would be the commercial aspects in terms of what would be the pricing and client negotiations aspect would look like, right? So for every scenario, all of these things, and it took us a lot of time. Most of the March and a large part of April were gone into actually fine tuning all of these, and we might still be very off, by the way, right, after doing all of this, but at least we did give it a try, Arpit, in terms of doing all of this, right? The second thing that we
if you could talk about what did you learn was the reaction of the founders, and then summarize the key learning.
Sure. So the reaction of the founders, the founders took it very, very well, by the way. They are much more deeply, affected by this than probably even, all of us sitting and most of the attendees, right? Because they are directly in the business. The thing that they have started figuring out, let's talk it from the point of view of entrepreneurs and founders, right? They have very quickly pivoted their attention to fundraise and alternative sources of it. So be it ACT grant, which is a very good initiative by fellow venture capitalist firms, to programs like SIDBI startup program, which gives a loan of 2 crore program, to figuring out various credit lines and venture debt scenarios, right? That is one of the big focuses that I'm seeing from the founders. So okay. I'll stop here.
Thank you. You want to touch base very quickly about supply chain and what is the impact on logistics sector?
Yes, I'll probably spend another 1 or 2 minutes more on this. So supply chain, as a sector, is actually at the forefront, and most of the guys here would realize that we are still running on stored inventory. So whatever shortages that you are seeing right now, they are going to go up only, not down, because the stored inventory will run out, and if the manufacturing operations do not start, right, you will end up with more and more shortages. So supply chain is in the focus of it. And if you guys would have heard Mr. Modi's last evening address, he also mentioned about it a number of times. So there, very quickly, I'll mention 2 quick trends, and we can discuss it in detail in the later half of the conversation. One is spot booking. So we are seeing most of the portfolio companies getting a lot of inquiries on spot bookings, versus earlier it was everything on contractual basis, and long contracts, 2 months, 3 months advance bookings, and all of that were common. Right now, everything is on spot, right? That is one aspect. The second is a lot of focus on track and trace and digitization, right? So many of the SMEs and even corporate clients have been caught unawares in terms of they have no clue that where is their inventory located, where are the trucks, what is the inventory levels at warehouses and all of that. So big jump in inquiries for digitization of their supply chain. These are 2 trends that we have seen.
This is so cool. Thank you, Ashutosh. I want to jump over to Shashank. Shashank, you also work with much early stage companies. We see that there's a lot of impact on them because not too many of them had enough money in the bank. and not too many of them had proven their business models to be able to raise significant capital. How are they dealing with it? What are the best things that you would advise fellow VCs to use uh, that that can help them manage their portfolio better or guide them better?
So I think we are a very different VC. We are a first check into these MVP and early traction startups, and within that we are in backing those companies who are just rolling out their products and just gotten first end customers, to also companies who just managed to get, let's say, a monthly recurring revenue of 15 lakhs per month. That's a hypothetical example. So our learnings from the last 60 odd days was ensuring that they continue to sell their product, sell their solution, and they have customers, because our ticket size and our check would not last them beyond 6 months. So our inherent ability to help them raise the next round of funding based on certain metrics like sales and revenue was very critical. So we spent a lot of time ensuring which companies can pivot. We also learned that which companies were able to pivot. Some of the companies were in a tight spot purely because of the lockdown, and they weren't able to go out and meet customers face to face. While on the other side, we saw a bunch of companies who really did well. We have a company called Renal Project, which is in dialysis centers, and that really did well, irrespective of COVID or not. Education technology as a segment picked up. One of our portfolio companies, which is Nourish, an online SaaS platform company for academies, uh, is really doing well, has onboarded 4 schools domestically and internationally over the last 60 days. So our focus was to ensure that they continue doing their business, and most critically, there were some ongoing conversations with HNIs and early stage seed investors post our check, and those were on the verge of closure. So we had to ensure that we can close those transactions. Some of them are still ongoing. We're still in conversation. Some have gone ahead and closed, so that bit was promising. But as I said, this is a different layer of space we are operating in. We are, as I said, backing very early stage entrepreneurs, ensuring that they continue to build out sustainable businesses in the coming months, more than a year, and become fundable for funds with growth stage VC funds. So my key inputs or feedback to the growth stage VC funds is that we continue to invest, while some investors would want to manage their portfolio companies, and that's fair. But as a function of our fund, we need to continuously back these entrepreneurs. And while we are sector agnostic, I'll be very open about it. We are staying away from certain sectors purely because we're not sure how they will pan out in the next 2 to 3 months, and that is travel, tech, mobility. But otherwise, we are excited about any other sector, which it's an open canvas right now. So from my vantage point, I think this is what we are seeing right now.
Excellent. Thank you, Shashank. Very interesting point about remaining away from a certain sector, and the fact that there's a time when you know when the founders can pivot and not pivot, and there's a lot to learn from it. Thank you. Manu, you obviously invest into later stage of the companies where hopefully they have much better finances and more money in the bank, so their business is not really under threat. Do you also experience the wave of uncertainty? And if you do, what is your advice to the founders?
So thanks for this opportunity. And so just to before I just get answer the question, I think the way we see our portfolio is we divide it into 2 to 3 parts. One is where we see an opportunity to take advantage of the situation where we have consumer companies in segments like biscuits and breads. And there, I think the strategy is really to accelerate growth as much as possible, but be very careful of the health situation. It should not impede us. What we're finding on the ground is that credit has almost vaporized in the supply chain. So your distributors, etc., who used to be highly reliant on credit, are now finding it difficult. But there are avenues of cash available over there to come in and keep the business going. There are certain segments which we have to be completely on the defensive, like the restaurants business and all. But alternative strategies are over there as well, in terms of home delivery, etc. And then, of course, there's a segment which is complete wait and watch, which is financials. But in spite having in larger companies certain amount of reservoirs of cash and liquidity, the fact that you're unable to project more than 2 to 3 months out as to what will be the health situation does impose challenges, and it will be unfair to say that one is entirely completely in the comfort zone. So even in our most happy situations, we ensured we drew down enough liquidity in the month of March from banks where we had working capital lines to supplement whatever other pools of cash we had. Those steps were done. Now, and till we don't get a handle on when the situation will unwind in terms of opening up and different industry will be impacted separately, I think it's very difficult to put a finger on the question you asked.
Okay, this is useful. Thank you, Manu. Over to you, Bharti. You have a small portfolio of companies as well. Of course, they are relatively older, relatively mature in their life. How are you seeing this opportunity this crisis playing out?
Yeah, but like you said, one for us, in India, we'd have exposure to maybe 30 plus companies directly or indirectly. And like you said, because we come in at a relatively later stage in the life cycle, we tend to generally have exposure to companies with relatively more stable balance sheets and a cash flow situation than, say, some of the earlier stage companies. Having said that, obviously in these times, despite the sort of stage of the company, figuring out what cash flows are going to be and what potential business plan could look like over the next few months is really critical. And as Ashutosh mentioned, we've been working around different scenarios with our companies as well, trying to figure out, for instance, if COVID comes in a second wave, what does that mean for companies? And if say business picks up in Q2 versus Q3, Q4, what does that mean, right? And really working with them to ensure that they are well funded, either through financial intermediary relationships that we may have in the broader ecosystem, or even evaluating more equity infusion if it's needed. So that's really how we've been trying to navigate the COVID issue. Specifically, I'm happy to speak about consumer, for instance, which is which is a sector which which probably has seen some of the deepest impact. And within consumer, one of the interesting trends we are seeing is the fact that in India, consumption tends to be very concentrated in the urban centers, right? So depending upon which product category you're looking at, you might be looking at the top 30 cities driving in the context of 40 to 50% of overall revenues for a company, depending upon category and stuff. And given that a lot of these larger cities are in the red zone right now, we expect that recovery will take a while on the consumer side to flow in. Obviously there are, within, while it's, each category to itself, but within consumer products, we are seeing that for discretionary categories, you could be looking at an FY21 number, which is 10% lower. Consumer staples could be, 0 to 5% odd. I think consumer services, like Manu referred to, stuff like restaurants, etc., obviously are seeing a very steep impact, which is really hard to immediately predict because it's sort of a nil revenue, few months that they might be looking at. So that's some of the things that we are seeing within the within the different categories. We are also using a lot of our China expertise. So as a fund, we work very closely on the China side, which is 50% of our business, and trying to see how some of that has evolved and seeing, if that's something we can bring in into our portfolio companies and sort of help them as they think through these different scenarios.
Thank you. This is very useful. I want to go back one more round across the table and want to ask you, what did you learn in this process, and what is the best advice you would give to fund managers to manage this situation? Manu, you want to go first?
Yeah. So I think one of the thought process that is evolving over a period of time is, I think, where people believe that in certain tailwind, for example, to 2017, financial services would have been a sector that would have done well. Am I audible?
You were breaking, but now you're okay.
Hello. Can you guys hear me?
Yes, now we can.
Yeah, sorry, I think there was a tech glitch. Yeah. Sorry, apologies for that. So what I was saying was that, the pre-COVID situation, there was a view that certain sectors would do well and a large number of players would do well. I think one will have to do a far more nuanced strategy assessment within a sector in terms of ascertaining who will do well. So we believe that the post-COVID, when, for example, till 2017, it was believed that financial services and NBFCs were to do very well. I think the post-COVID situation, one will be hard-pressed to find, other than gold loan, what will really be a large winner unless there's a major reversion of the health situation into a beneficial state. Similarly, in many other sectors, whether it's consumer, whether it is an ITES, what sort of services will do well. And I think those winners will get ahead even further than they would. So we believe that more micro company specific product opportunity, even SKU specific analysis would have to be done as to what will be the share of wallet in their customer group, who will be the new purchasers, what will be the impact on cash flow, balance sheet, P&Ls very, very differently. And I think that micro analysis will be the order of the art as we go into a post-COVID world.
Thank you. This is useful. There's a quote by Artan Senna, which was recently shared on Twitter. He said that he's a champion F1 player, F1 racer, was a champion. Fortunately, died on the track. He said in a sunshine day, crossing 2 or 3 drivers is hard, but when it's raining, you can actually cross 21 because you go from back to the front if you are, of course, you're playing your cards, right? So yeah, well said. Thank you, Manu. Shashank, what did you learn in this process of helping portfolio dealing with this crisis, their responses, and now if someone is doing it afresh, or if you were to do it afresh, what would you do differently? What would you advise people to do?
So I think massive learnings. It's a situation which has no preconceived answers. We don't have a history book on the situations addressed in the current format. Now, I think our key learnings from a fund perspective was purely focusing on the early stage innovations, and we felt that this, and we're still very optimistic, and I'm very optimistic that this crisis will, at least for the early stage entrepreneurs and early stage businesses, pave a path for solutions which could have taken time to be implemented all the way up to 2025. And now you're seeing that channel opening up where they're arm twisted, or for a lack of a better word, arm twisted or compelled or pushed to utilize these tech solutions. And I'm particularly excited about that. So while I agree with Manu's perspective, but on the other end of the spectrum, for early stage entrepreneurs, I think this is the best time to be building out solutions. And from a fund perspective, I think it's the ideal time to be backing these entrepreneurs. We will definitely see a valuation correction for sure. And I think the whole valuation game and the valuation argument and conversation will be much, much evolved, much nuanced, and much India-centric going forward. So these are my quick thoughts on that.
Thank you. That's very interesting, Shashank. Ashutosh, you want to talk about what did you learn?
Right. So very quickly, one thing which we have all probably realized in certain measures is the fact that VCs are no longer just interested in growth, right? And growth as a metric was one of the biggest metrics that anyone was, evaluating before taking a decision on actually investment. And right now that metric has gone out of the window. So what are the things that we should be focusing on? And the jury is still out, right? I'm no expert in that, but from our side, at least, what we have started looking at is that divide what the firm is doing into at least 2-3 different categories. Whether what they are doing is essential, necessary, or you can say vanity, right? And these are the 3 categories. Essential, just like on a customer basis, your groceries and everything is essential. It's not even necessary. It's really essential. You cannot live without it, right? So the offering that you have, be it B2B or B2C, whether it is essential, whether it is necessary, or it's good to do, right? So that is one big metric that we have started, or a lens that we have started looking at. And the second is that what we have learned is the fact that really innovative models. So to Shashank's point, right? This is the time we have even seen in 2008, really innovative models come out. So we are on constant lookout for those innovative models. And it would be my earnest request to fellow fund managers, as per Arpit's point of view, that fund managers, let's look at innovative models and let's back some of those really good innovative models, because that is where we will actually make money.
Perfect. This is so cool. Thank you. Straight from the heart, Ashutosh. Thank you. Bharati, you will top it up with great advice to fund managers?
No, always good with free advice. Yeah.
Yes, please.
No, but I think one of the probably more humbling lessons, right, and it's a good reminder for us as investors, is to really be wary of deals that are priced to perfection. I think what this year is going to pretty much, we'll probably be looking at a lost year for our underwriting for many companies, and as private equity firms which write, very detailed business plans. That's quite important to just keep in mind that could happen. And, to ensure that we have enough room in our hold period, in our exit multiples, to allow that room for error. And I think that's probably been one pretty big lesson we've taken away as investors this year.
Thank you. This is excellent. Thank you, Bharti. I want to stay with you and talk about a second section of our webinar today, which is about fund managers. And since you are representing the entire secondaries players in the industry, we want to talk about how are you looking at this, your LPs as well as secondary players. How are you looking at it? Your portfolio consists of fund managers like us. Are there any tailwinds? Are there any silver linings? Or is it mostly doom from the way you look at it?
No, I think there's a lot of silver lining, but I'll start by commenting on the dooms part.
Yeah.
I think, look, what we are seeing as a liquidity solutions provider, and I'll comment more on a bunch of new deals that are to come in. Many of our fund solution deals are relatively young in their journey. So I think, for them, it's okay. But what we are seeing as investors looking and scouting the market for new deals is that many fund managers now expect to hold their assets for somewhere in the context of 6 to 18 months longer than they would have originally planned to. And that does mean that, liquidity, and especially given where capital markets are right now, and where they're probably not going to bounce back in a big hurry. I think the importance of liquidity solution providers like us increases in this sort of an ecosystem, and that's what we are seeing with some of the funds who we've been in conversation with previously. We are seeing in general an increased amount of deal activity. Where we have funds, who may be looking at solutions around restructuring, or generally, I think in the market, what we understand is also there are a fair number of funds which, given COVID and given this last year, that we might be looking at potential extensions of their fund life. In general, what we also understand is LPs are willing to grant these, right? And because I think the LPs understand that it is an exceptional year to go through, and they are being very supportive of their partner GPs. I guess the broader trend in the secondary market that we do see is, especially after I think the next 6 to 9 months, which is when probably some of this might become a little bit more steady state, is when we will see a secondary activity pick up a lot. We are seeing lead indicators to that, but I think, in terms of deal closing, that's probably when we'll see a lot more deals closing. Post the GFC, in general, secondary volumes went up in the context of 4 to 5 times over the couple of years following GFC. So definitely we see secondary activity picking up. We see the need for alternate liquidity becoming more important.
This is great. Because you said that we expect the fund managers to be LPs to be a little more sympathetic. I'm just asking a question which is suits my interest. Shall we expect a little more leeway from the LP side as fund managers, because we are definitely not performing as well as we would have in a better year?
Yeah, no, definitely won't take the onus of answering that at all. I think what we can see is only what we see from, other fund managers who are there. And I think people understand, right? And honestly, beyond a point, you don't have an option but to understand. So, if only for that. But I think LPs in general are definitely being supportive in this ecosystem for sure.
Just one more follow-up on this. When the LPs look at this asset class, which is startups and PE, VC and PE, do they necessarily still compare with what will happen in the public markets, and they will then find it more or less risk-prone to take more or less exposure to VCP? What is your sense? Is VCP getting slightly more in favor or less in favor given COVID?
I think it's too early to say.
Okay.
Really, because public markets is a different style of investing. The volatility is a lot higher. It's a very different risk appetite. So typically, the inherent decision is determined more by the risk profile of these two asset classes. And I do think that since we're just a few months in, probably by the end of the year, we could see some trends emerge. But I do think it's a bit too early.
It is early. Okay, fair. Guys, across the table, you can pick up whichever order you think is relevant. How are you looking at its fund managers and seeing, okay, what can we do best about it? The most obvious thing to do is to maybe conserve more capital for existing portfolio and maybe go slow on the new deals, which I think everyone is already doing to some extent. But are there more strategies than that to play here? Ashutosh, Shashank, Manu?
Yeah, I mean, at our end at 100x.vc, we are backed by the Mehta Family Office. It's a family office backed fund, which is run by Sanjay Mehta. And the core focus and thesis is to deploy money in early stage companies. So we will continue to invest and hopefully reach our target of 100 startups a year. We are going to go aggressive in terms of backing early stage entrepreneurs. Our ticket sizes are fixed, and we have a cookie cutter kind of a format, so it works very well for early stage entrepreneurs. And we don't do follow-on funding for our portfolio companies. So hence it is as a function of that, 100x will continue to look at early stage entrepreneurs. As I said, we are sector agnostic. We would want to continue to be sector agnostic, but I think as a function of COVID, I think certain sectors will not be looked upon, as I mentioned earlier. And I think for the next quarter, we might stay away from that. But otherwise, we are out there investing and looking for newer opportunities.
Thanks, Shashank. Ashutosh, Manu?
Yeah, if you allow me, Manu,
Yeah,
can I go next?
Yeah, sure.
Okay. Yeah, thanks. Just quick, a couple of things that I would like to talk about to the fellow fund managers. One aspect is to, as I said earlier as well, look at innovation, be it outside in terms of new investments or encouraging the existing portfolio founders to really innovate. I mean, if somebody as large as Zomato can quickly innovate and come out with grocery delivery, and 1mg can tie up with Reliance Retail, right? Why can't you look at certain innovative ways in which you can develop the business? So that is what we are definitely pushing, and I would love to actually work with other fund managers on this, right? The second is a learning that in usual times there is a little bit of a distance between large corporates, SMEs, and startups. Ultimately, startups are unless it's a B2C startup, a B2B startup is designing a solution for a corporate, right? And corporate behaves in a certain manner. But these days, I have seen such wonderful conversations happening between even large corporates and startups, right? And my humble request would be to everyone to actually utilize your own corporate connects. I mean, all of the fund managers are, to some extent or the other, work with large corporates in various capacities. Let's utilize those connections, talk to them, and figure out what can be done very quickly between those large corporates and the startups. I was surprised myself, when I started having those conversations. You might be too.
This is very interesting. I didn't think of large corporates and startups because we have a lot of relationships. I don't think we are doing an excellent job of. We can definitely do better on those relations. Thank you, Manu. You want to add a piece of advice?
Yeah, so I think to the original question that was being discussed, I think when we look at new opportunities, the way I think we've kind of divided our thought process is to say that there are going to be some people who are in advantageous situations, but they're going to be expensive. And when you look at the risk of investing, it's really got categorized in two parts. Do you go after them and pay high valuations and then run the risk of having paid too much? Or then do you look at businesses that have got disrupted? As an example, it's a listed company and we know about it. PVR, that business is disrupted and the share price is adjusted. Now, then do you take a business risk over there and say there's a point of time when this business is going to come back and the current valuations are just too attractive to miss out and take that sort of a risk. My opinion is that it's safer to take the first risk of identifiable winners and maybe paying a little more than disrupted businesses where there's an underlying health situation which is still unknown. We may be exiting a lockdown, but the prolonged nature of the pain in various sectors could be, it's a medical response that we are waiting for. But that's the way I would think. But having said all of this, my view is that this is an opportunity set for fund managers to identify and put up capital to help businesses, but also make very sensible deals during this period of time. We'll probably look back a couple of years from now, and we'll probably be known by what we did during this period in terms of putting smart capital to work.
Thank you. This is great. Thank you, everyone. One last question before we open for questions. There are a couple of questions on Q&A as well. What is your best prediction about the sectors which are probably going to have an upswing, tailwinds after COVID? One quick round. We definitely took a poll, and then we'll match with the poll. Bharti, you want to go first?
Sure, can go first. So, couple of themes, I guess, and I'll speak generically. I think healthcare in general is a sector which is going to be more defensible than several others. We are seeing ITES is another sector where, specifically in terms of pricing, because of the way public markets have been, because of broader shift to cloud, pricing has been correcting for a while, and it's taken a further beating down with COVID. However, when we speak with our portfolio companies and generally understand from what's happening in the market, there might be several plays within ITES that might be a little more defensible than pricing, which seems to have dramatically corrected. So I think there can be some very interesting opportunities over there. Within digital, and I think that's something that's going to be really interesting to watch, because it seems like, obviously there's been an increased amount of digital adoption over the last couple of months, and many surveys indicate that consumers are going to stay with some of these digital habits. So be it wallet payments, be it fitness classes online, education classes online, and a bunch of sort of sub trends within that. Where definitely adoption, we expect the base might have just shifted upwards a little bit. And those are going to be some subsectors we are going to watch and track closely.
Thank you. This is useful. Manu, you're talking about a sector?
Yeah. I'll just take a slightly different approach, Arpit, if it's all right.
Sure.
So I think we are seeing prolonged period of high volatility. The India VIX, if you look at it, it's it's really high. What it's doing to businesses, if you examine even within sectors, and I think the opportunity assessment is within the sector, you'll find that various businesses have different margins of safety, and high volatility can put these businesses with low margins of safety in terms of whether it's gross margin, operating leverage, or financial leverage. It doesn't. It's not very complicated. So you have to keep going within sectors and finding businesses with high margins of safety that can sustain pain in the balance sheet and the cash flow. The P&L can come later. But if that ability of taking pain is less, then even within sector, I wouldn't give broad brush assessments. But at the risk of being boring, I will say that tech, telecom, and healthcare, pharma, obviously as larger sector groups outshine. And I don't think I'll be adventurous in taking a contra view in financials at this stage.
Okay, thank you. Shashank?
Yeah, so the kind of sectors, at 100x, we are excited about fintech for sure, but not lending businesses. Definitely not. Adding to Bharti's point, and I completely agree with the ITAs, and within that, the subsets of, cloud infrastructure, collaborative SaaS platforms, all of that is quite exciting. Healthcare services, telemedicine platforms, PaaS platform as a service, very interesting space. And last but not least, education technology and agri tech. I think these two companies, these two sectors will see a lot of interesting models coming up. We've backed a few, and I'm pretty optimistic about these two. But as Manu rightly said, and I couldn't agree more with him, is that in all this, I think businesses with high margins are going to be the clear winners. And those models are emerging in some cases, and I think those are the ones to look out for.
Thanks. Before we go, Ashutosh, you speak. Everyone who's listening to us, if you have a question for the panelists, can you please put it in the Q&A? And it would be nice if you also name the person you wanted to be answered, or leave it and I'll pick it up and get it answered. Ashutosh, your last comment.
Sure. I would not hazard a guess here. So I stand for supply chain. The name of the fund itself is Supply Chain Labs. But even inside supply chain, right? Very interesting models, and that is what I would focus on rather than subsectors inside. Because as Manu rightly said, we are entering into a prolonged period of very high volatility, right? And to what Bharti and Shashank said, given this volatility, various kinds of things will emerge, and we'll have to be lookout for that, right? So we are right now focusing on what is the kind of innovative things that that entrepreneur is bringing to the table, and focusing on deal by deal, conversation by conversation, rather than taking a broad sweep.
Thank you. So we have only 10 minutes left. Let me quickly jump into questions. We have a question from Anshul, which is addressed to me. How has Dunzo taken advantage of consumer shift, and how are they expected to do vis-a-vis Swiggy? So Anshul, thank you for asking. Dunzo is doing quite well in these times. If you are based in Bangalore, your life has definitely touched, Dunzo has definitely touched your life. They have seen a significant surge in orders, significant surge in number of rides and demand, and all kind of things are now happening. A lot of newer people, older generation people are discovering Dunzo. So there's definitely a strong demand. I really won't be able to assess whether Dunzo is better or Swiggy is better. I know that Dunzo is smaller and Swiggy is far larger. They have a lot more money. So if they really wanted to be as good, they probably can be. However, at this point of time, Dunzo is seeing significant tailwinds, and hopefully that will continue for some time to come. Next question is about from Shobit, who's talking about, according to some reports, VCP activity will be slower this year, and they will only be looking at resilient sectors, which is true, Shobit. Do you think that this will create new opportunities for venture debt funds? So who wants to pick this up? Venture debt funds, is there an opportunity for VD funds to pick up?
I'll just very quickly take it up. Yes, and the answer is a big yes, because venture debt funds generally come on the back of an equity round being raised, and in current scenarios there are certain venture debt funds like Stride Capital that I know of, which are actually coming off from that model and saying that okay, we will fund good businesses, whatever stage or whenever they had raised their equity capital. So absolutely, please do look at venture debt as one of the methods to increase liquidity in your startup.
Anyone else who wants to add to this? Okay, not a problem. There's an anonymous question who's talking about anyone having an interest on marketplace for construction, logistics, education, and MFI. Now, I don't know who this person is, but if they're saying, I have a choice of starting up in all of these 4 sectors, it is kind of confusing to me, and because we can't say start in all the 4 sectors. But let's take a view about, out of these 4 things, construction marketplaces, logistics, education and research on capital market especially, and microfinance institutions. Is there any tailwind or any of these? Karthik, you have a view on this?
Yeah, I'm not, I guess, I just want to be clear about the question. It's just picking amongst these, which might be.
Yeah, which was these probably works out.
Yeah, it's a really hard question. But definitely, I think education and e-education in particular, I think is significantly set to benefit in these markets. MFI is going to be very tricky depending upon what your loan book looks like, very tricky. Asset construction infra is going to be tricky given how real estate is going to play out, and logistics we've already heard a little bit, but I think off that I'd pick education if I had to pick one. Yeah.
Excellent, thank you. Manu, Shashank, you want to pick one sector out of these 4? Sort of randomly picked sectors, and I don't see a pattern here.
Yeah, I'll go there. So again, my approach is slightly differentiated than just going on a broad sector approach. I think the bootstrapping strategy, whichever sector you pick, I think is going to get a period of wait. 18 months, 2 years. You cannot be. I think people who are sufficiently funded, the old-fashioned, comfortable balance sheet is going to be, whether it's microfinance. And you do find that there's some transactions taking place in the microfinance segment, even as we speak, in a complete lockdown situation with less than 20% collections happening. So there will be differentiated plays over there. But I think logistics supply chain is, going to be, it's going to find its due, which it hasn't found in, decades of, at least in the valuation that market has been giving to it. And it's going to find its place in the sun.
Excellent. Thank you. There's a question from Niladri about, will the push for profitability intensify in post-COVID-19 world? I think the answer is yes. But across the table, can we please qualify this? This is an important question. Are we seeing a world where profitability is far more important? Yes. But what are the nuances? Who wants to go? Manu?
Yeah, I'll take that up. So, profitability in a microfinance, in a financial services company, when a bank is there till it's there. The day it vaporizes, even the net worth and the book value vaporizes. So both profitability and book value, I think the question to be examined is survivability. If you're going to invest in businesses that have very low threshold of tolerance to volatility, and the question doesn't come to profitability or cash flow, it comes to survivability. I think that's really where people will start making assessment. I remember a decade ago, or probably more, when I started learning to this trade of private equity, we would spend inordinate times about doing downside scenarios. And we would keep looking at it and checking for real examples in the market to see what will be the stage at which this business will fail. And we would be very certain, double diligence it, and then say, okay, this is the margin of safety of the investment or the valuation I'm paying. And I think that's beginning to fade over a period of time as businesses have hunkered up, bootstrapping, and growth has happened. I think the old ways of checking downside scenarios will be the approach. Survivability will be more important than profitability.
Thanks. There's a question from Tehseen Danawala about, given that this is a Black Swan event, is there an appetite for formal leadership and leadership development and coaching? And would VCP like to conduct such program for their portfolio? Has anyone tried this across the table?
So and I answered that as well on the screen, but we have been evaluating certain options. But our focus right now, as with everything else, is result oriented rather than more of a personality development workshop. So
Yeah.
so that is what I would focus on. But definitely open to that.
Okay. But you have not tried it before.
No.
Okay. Anyone who has done sessions like those for portfolio companies? No. Okay. So there's definitely openness to it, but I can imagine that we have not tried it. It's fine. Manu, financial sector question. What subsectors, maybe Bharti can also chime in, what subsectors in financial service sector will play an important role in post-COVID world?
One, which I had mentioned before, gold loans. I think I think gold is going to be a contra play as a metal. And because of that, as a precious metal, it will create more and more lendability against the thing. So the LTVs are going to come down, and that will, even for the existing customer base, there'll be an opportunity to lend more. And gold, the pools of gold are available. That's going to do well. And I think the public markets are kind of acknowledging that already. If we were to include the non-lending portion in the broader financial sector, I think insurance, there will be a broader realization of requirement of insurance, especially general insurance, in the larger middle class, to say that this is critical and things like this can happen in their lifetime. If you just go back and look at the saving patterns of the post-depression populace in the United States, people were big savers at that point of time, etc. So I think there's going to be fundamental psychological changes towards insurance, which will play out in the success of the insurance company, especially in the general insurance category. So I think these two categories are
general insurance and gold loans. Yeah. Very good. Thank you. Bharti, you want to add to it?
No, not really. I think I echo those completely. Plus, I think we've discussed on fintech earlier. Yeah.
Yes. Okay. Yeah. Ashutosh, we have a question on EV. So what is the thoughts on e-mobility, EV sector? Do panelists think that they are readiness for funding? This is one question. Other question is about if supply is dependent on China, shall we dissociate with it? And are these anytime going to become more affordable?
So first question, I would like to answer it in a different way, that, if we are looking at only the COVID scenarios, obviously, the discretionary spending and all of that is going to go down. But if I flip the question from a point of view of corporates and then marry it with the oil price crash that has really happened, right? We have a bunch of very large oil and petrochemical companies scared out of their wits, saying, thinking about what do we do next, right? And alternative sources and alternative ways for mobility is one of the big agendas that most of the manufacturers and oil producers are actually now driving. So my guess would be that the push would come from the vehicle manufacturers, from the government, and that is where we'll see the supply shaping up really well and the prices coming down, rather than the push coming from the demand side. So that's my view.
Excellent. I think this is very relevant. Do you want to comment about how whatever the supply chain of EVs, like we are dependent on China right now, do you see that emerging in India?
No, so the supply chain, we are dependent on China, no doubt about it. But two quick things. One, people have started figuring out alternative ways, areas where to source. It's not just that everything comes from China only. It is just that China is the cheapest place to source from, right? And if you're not getting it, you'll get it slightly expensive from somewhere else, right? The second thing about the supply chain and sourcing of EV is the fact that there are tech kind of solutions and really good companies in the battery management space that are now beginning to shine. Previously, everything was on pure mobility, and now some of those aspects are playing out.
Excellent. Valuation question to you, Shashank. How should founders be thinking about valuation post-COVID? And generally, people feel that valuation is not an easy topic to understand.
Yeah. So, at our fund, we try and not assign a valuation, hence we use the instrument, safe instrument. at growth stage, possibly transactions happening at Series A, I think valuation becomes more relevant. So my only suggestion to entrepreneurs, particularly who are just starting out their journey at an MVP or an early traction, stop thinking about valuation. There are instruments where you can, raise money and just focus on building out a business. I think valuation becomes more relevant when you become, possibly raising a third round, which could be possibly a Series A and Series B beyond. That's my 2 cents. We at 100x, I think we all our investments are done through safe instruments. Try and push forward the valuation purely because there's only so much you can assign to a company at an MVP or an early traction right now. I think the ability of building out a sustainable business, again, over the span of 1 quarter, 2 quarters, and a year is more important, I think, and that's what founders should be focused on. Valuation is a conversation they can have with incoming investors at a later stage.
Thank you. Bharti, you want to talk about a very different perspective of valuation?
Yeah, no, I think it's going to, we've been wondering when private markets will catch up to public for a while. And, I think with this massive correction that the markets have undertaken, we do expect as rational investors that, there will be, some pricing correction, especially as many of the companies we invest in, the exit might actually be to public markets. So for us, that's a very tangible input that we need to factor in. So in that sense, definitely, I think we expect some amount of rationalization. From, in the past, we've seen EV to GMV kind of ratios moving to EV to S ratios. And, maybe at some point, it'll get closer to EV EBITDA, and that's something, eventually happens. Yeah.
Superb. We have a question on automatic route, PM3. I'm not sure who is an expert here, but if someone has taken some time to go through it in detail, Bharti, you have China connections. Please talk about what is the feeling from on the other side of the border.
Yeah, so I think I haven't read the latest, most detailed text, but my understanding here is that it's going to be all investments which need approval eventually, rather than an outright ban, right? So it might take a little bit longer to process some of these investments, and which does make it a bit harder. But I mean, it doesn't seem like the government intends this to be an entirely closed route. So in that sense,
there have been 2 term sheets which have failed in recent times after PM3 in our portfolio, which is I think it's mostly a mood swing where it changes mood and makes people on the defensive. So those conversations have fallen after the paperwork had started. But probably they are more reasonable people and they will come back. But there is an impact, at least on the mood.
Interesting that you say that. We are still trying to figure out the impact here. Yeah.
Okay. Other people want to comment about China FPN3?
No.
Okay. Great. I think we are done with all questions. One last question is about supply chain and lending business, which we have answered amply enough during our conversation. Amit, do we have more questions from your side?
No, I guess we had a decent amount of engagement and all the queries answered.
Thank you.
And almost in time. Exactly, I guess we just hit 1 hour. So I mean, I would like to thank all of you, for this. I mean, Shashank, Bharti, Manu,
thank you,
and Arpit. I mean, really intriguing discussions, and I'm sure we'll take a lot of value out of it. We'll also, try and summarize a little bit of this and share it with all of the attendees and even those who missed out on this through a blog on our platform. And really, thank you very much for coming and participating in this.
Yeah, and also 4 o'clock, I think the finance minister would have started her.
Yeah.
I think is equally related, and let me wish everybody the very best for it.
Yeah, the best everyone. Yeah, thank you. It was great having you.
Thank you, guys. Thank you for inviting me. Bye-bye.
Thank you, everybody.
Bye. See you.
Bye.
Bye.